Today on the CEO Barbecue, we're looking for gold and silver in South Africa and maybe a little bit of it in the US as well, together with Golconda Gold. For a bullet point summary of this and all other CEO interviews, please go to resourcetalks.com and subscribe to our free weekly newsletter. The company you're about to hear from has not paid us for the production of this interview, but this interview is still intended only for experienced speculators because this is venture capital and mining is a very risky industry where failure is the norm. All conversations are general and impersonal in nature, and they contain forward-looking statements. I'm not a licensed financial advisor, and my business sells content-producing services, which also makes me biased. So before continuing on, please talk to an independent investment advisor with a good long-term track record because your capital is at risk, and also visit setterplus.ca where you'll find the company's official filings. If you're not 100% sure you understand all the biases and the disclaimers that I just showed you, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said herein. That all said, Golconda is a gold producer with operations in, again, South Africa and the United States. Those are the two cornerstone assets that are worth discussing here, but it is really Galaxy, the company's South African operation, that is currently generating cash flow and will be the focus of conversation today. The underground operation and associated plant produce a gold concentrate, with the mine delivering close to 10,000 ounces of gold so far in 2025 and ramping up production on the back of a 50,000 ton per month plant that is, by the way, still running below nameplate capacity. And we'll definitely talk about that as well. Goal here, as far as I understand it, is now, well, although of course that's something I'll be asking more about as well, is to steadily increase ore tonnage and output from Galaxy toward an envisioned 40,000 tons per year by 2028, supported by a multi-million ounce resource base and ongoing underground development across multiple mining areas, including the Princeton ore body, which I won't say too much about it right now, but it is something that I hope Ravi will be touching upon later on in the conversation. On top of what's going on in South Africa, Golconda is preparing the restart of the Summit silver gold mine and the nearby flotation mill in New Mexico, targeting a mid-2026 production start and approximately 12,000 gold equivalent ounces per year at steady state and well, potentially a spin out. Again, something else that I will touch upon as well. Will that go smoothly, though? Can Galaxy and Summit together serve as a cash flow growth engine for the company, thus being unhedged and thus mostly relying on the spot market? And how do they deal with political risk in South Africa? Those are all questions that I hope I can get some answers on in this conversation. Golconda is listed as GG, so that's it, just two letters, G and G, on the TSXV, where the average 3-month volume is about 200,000 shares. The stock's 52-week high is $2.44, and its 52-week low is 22 cents. With a market cap of just over 125 million Canadian dollars and just under 72 million shares outstanding, today this is a $1.75 stock with a 50 and a 200-day moving average at respectively $1.92 and 92 cents, which means the stock is now trading between the two. Moving on to the share structure, an important thing to note here is that over 42% of the shares that are outstanding are owned by management and insiders. And how those shares were acquired in the first place will also be discussed later on. Again, just under 72 million shares outstanding, though, no warrants, and about 5.5 million DSUs on top of just under a million stock options. They bring the number of fully diluted shares to just over 78 million, meaning an increase of just about 9% in shares outstanding could happen if all dilutive securities got exercised, which would then result in about an 8% ownership dilution if, and that's of course always a big if, but if all dilutive securities actually get exercised. Talking about money, I'll now go through their latest financial statement, which shows me the numbers as of June 30, 2025, which is almost 5 months ago now, and thus covers only up until Q1 and Q2 of 2025. Although Q3 is being closed and hopefully financials on that soon as well. At the time, though, at the end of Q2, the company had in total just over 4.3 million US dollars in current assets, about $1 million of which was in the form of cash, 700,000 in inventories, and about 2.5 in account receivables. In terms of liabilities, Golconda does have some short-term and long-term obligations with respectively 8 million in current and 7 million in non-current liabilities. For the short-term obligations, it's about 5 million in account payables, 2.5 in loans, and about 600,000 in deferred revenue. Non-current shows more deferred revenue at close to $5 million, as well as a $2 million restoration and rehabilitation provision, which is what it's not actual debt that has to be paid back immediately, but maybe we'll touch upon that as well. Moving on to the P&L for the 6 months that ended on June 30, unlike most companies I speak to, Golconda actually has revenues recorded at about $14.3 million for the 6-month period. That's almost 3 times the amount recorded for the same period last year. After the operating costs at the mine level, that's left them with $6.3 million of earnings, again, at the mining level, which is almost 14 times as much mine level profit as the same period last year, despite, again, revenue being up less than 3 times. Of course, running a mining company also costs money. So the non-mining expenses, such as your G&A and financing expenses, et cetera, they came in at about $2.5 million, with corporate G&A sitting at just under $1.4 million, which is an average of about $225,000 per month to keep the lights on at the office and the staff happy. But that does include some non-cash expenses, such as about a $350,000 worth of share-based comp. All this means that Golconda is or was actually profitable during H1 of this year, bringing home close to $4 million, 3.88 million in net earnings to be specific. The cash flow statement also shows those positive inflows from operations, repayment of debt with an effective interest rate of approximately 9%, and investing activities consisting of the acquisition of mining assets, which is something we'll touch upon later on as well. But finally, it's leaving them with an increase in cash of just under $740,000 for H1. Now, normally for an exploration company, I would like making the exploration to administration ratio, which would show you how much money goes into the ground versus how much of it goes toward your bankers and lawyers and management. But here, I think it makes sense to look at how much of the revenue is spent on G&A, and that answer for GG is just over 9%. I also like seeing how much cash they actually get to keep from all the dirt moving activities and everything that goes with it, which I calculate as the increase in cash divided by the cash flows from operating activities. And that's about 14.2% for Golconda, meaning they got to keep about 1/7 of the cash that came in during H1 this year, which is actually less than the same period last year because there was less paying back of debt back then, and there was also a little bit less of an investment cash outflow. Now, is this going to stay here? Could they grow the bottom line without growing the corporate office? And how stable is the financial situation under the current assumptions is something I hope I can ask later on in the conversation. In the meantime, though, I would like to remind you that mining businesses can change relatively quickly, so the numbers may not be entirely representative of the current situation for Golconda by the time you're watching or listening to this. So it is your responsibility to try and get up to date on the numbers by the time you're watching this by visiting setterplus.ca. Now, I've mentioned that I have a lot of questions and that I'll ask later on in the conversation, but for this to actually become a conversation, I'm going to have to shut up already. And Ravi, I'll give you the word here. But first of all, thank you for sitting down with me today.
Thanks, Antonio. Great to be here. Appreciate the invite.
The pleasure is mine. And shout out to Ian Castle, who actually put us in touch. So I'm looking forward to this conversation. But since this is your first time on the barbecue, we'll have to go through the smell test first, which intends to understand more about what the incentives and track record of management are. But just maybe before we get into this, to set the stage here a little bit, Rick Rule always tells me that both big and small mines have big risks. But he says only big mines can give you the potential return to make that risk worth taking. So why should I treat Golconda any different?
That is a great opening question. And I'm going to start off by saying he is correct in almost everything he said. And we've certainly lived that experience. So we started off with what would be considered a small mine when we created the company, Golconda, back 14 years ago. It was called the Mupani Mine. And we've added 2 more small mines since. And, that is a factual statement. You put about the same amount of work into a small mine in terms of permitting, timeframes. We had an exploration success that's required to kick it all off. Maybe you only found 200,000 ounces and not 2 million, and that 200,000 ounces is justified in mine, but it's for all intents and purposes the exact same amount of work. And the pot of gold, excuse the pun, at the end of the rainbow is smaller. So you're doing the same amount of work and you need the same amount of firepower and talent, and your pot of gold at the end of the rainbow is smaller. So why do it? Great question, and it is something that I certainly reflect on myself. The difference with our strategy is that we are not out there building mines. The three transactions we've done in our corporate history, we bought mines that were in production or previously in production. So somebody had gone through the hard yards, blown their brains out, and in all of the cases, more than one party. So we weren't even the second owner; we were the third, or even more in the sequence owner. And there is huge value that we are purchasing. All that permitting, the discovery, all the permitting, the construction, licenses, getting the gremlins out to actually figure out what's going to break this thing, what's going to be the problem. When we wrote down 25 problems and it was problem number 26 that actually buried this thing, we're buying them and we're stepping into them on the other side of that. And our entry price in all these cases has been a fraction of the construction cost or replacement cost. So that's why it's been a worthwhile exercise for us. Would I start from scratch and build one of these mines? No, I wouldn't do it. I agree with Rick Rule. And same reasons. I would need the same talent that is required and pay the same kind of salaries to those people if you want to do it well to build a 10,000 ounce a year mine as I would for a 1 million ounce a year mine. So yeah, I think it's a case of agreeing to agree and just sort of observing that our strategy is actually slightly different, and it is also reflective of that. There's a reason why these companies went under. It wasn't anything wrong with the ore bodies. We were able to buy these mines because they hit a negative part of the cycle, and they weren't strategic enough to attract funding, or their overhead as a percentage of their potential revenue or revenue at the time was too high, and they went under, and that became an opportunity for us.
That's a lot of follow-up questions will come from that answer, Ravi, specifically about how you bought them and the history behind the assets as well. But I do want to go through that smell test first. And I'm going to start off with yourself and your track record. Talk to me about yourself. Who are you? And have you made more money for shareholders than what you've spent during your career so far?
Absolutely. So my career has been one of two halves. The first half has been in fund management. Ultimately, as CEO of an investment firm based in Toronto, I sold that company to a consolidator of fund companies approximately 15 years ago. And that kicked off the second half of my career, if you will, which has been as an entrepreneur, with I'll call it my day job being CEO now and previously chairman of Golconda Gold. In addition to that, I've also sit on a number of boards, usually or exclusively in a non-executive capacity. And with my executive focus being on now exclusively on Golconda Gold. We have, I'd say the first part or the first chapter of our history as a company was what I'd refer to as a failed success or a successful failure. We acquired the Mupani gold mine from IAMGOLD in 2011. And this was an end-of-life mine. It was deemed no longer strategic to IAMGOLD because it was too small. It was producing about 35 or 40,000 ounces a year for IAMGOLD at the time. IAMGOLD had grown since they bought it. They bought it for something like $240 million in 2006. And they sold it to us in 2011 for what was effectively worked out to $15 million. So a huge loss for them. But it was deemed a non-core operation and maybe would be better off in somebody else's hands, somebody like us, where it was their sole asset and they could put management focus on it and it would move the needle for them being at 30 or 40,000 ounces a year. So it had 18 months of mine life left when we bought it in 2011. We knew that could be extended. Based on our due diligence, we saw most of the geological work. That mine was commissioned in 2005. And the work that was done to justify the capital raise, the construction, commissioning that mine was done in 2001. So that feasibility study was done at $250, $275, and $300 an ounce gold. So stuff that would have been economic at $500 an ounce, $1,000 an ounce, never mind $1,500 an ounce. That was stuff that they walked away from. So we knew from just the data that we had, there's going to be a lot of opportunity to extend that mine life. So we went into it, and for Reinhold, they wouldn't bother. It didn't move the needle. For us, that was the business plan, and we pulled it off. So we thought we would for sure get 3 or 4 years out of it. In fact, we ran it for 11 years. We produced 332,000 ounces, just vastly exceeded what we had projected when we had acquired it, and we raised the money to do so. Our all-in sustaining cost was also lower than we had forecast at the time of acquisition. It came in at about $1,375. But over that time period, the 11 years that we ran it, and by the way, at the end of it, we sold it to the local management team. It's still in production, and I'm sure it has a future ahead of it still. That was 2022 that we sold it. We basically broke even. So a few years at the front end, right after we acquired it, still high gold prices, 2011, 2012. We generated huge amounts of cash flow, and then losses for many years after that because the gold price took a big dive in 2013, and we were struggling to stay alive. What we did do very well was cut costs and execute what I call a batten down the hatches strategy, which basically was figure out how to survive on the basis that gold price would recover. And even though our stock went down a lot and we had no access to capital and our operations we were just doing everything just to keep it together, the knowledge that gold price can move, it will move. And when it moves, it has profound implications for your operating metrics, your operating results, and also by extension, your share price. So if we can survive this storm, not knowing how long that storm would actually prove to be, we can recover all the value and then some very quickly, as long as we don't blow up the capital structure. So that was critical to us. So we were very judicious about our spending. We did everything just to kick the ball down the road, including stuff that was like sacrifices on an operating basis, not doing the kind of maintenance that we should have been doing, extending equipment replacement cycles, just flexing with our creditors and pushing out payments, doing everything in the book and then some to just extend and extend and extend. And again, with that theory that eventually gold prices are going to move, they're going to move fast, and it's going to have profound implications for our financial position. In fact, all of that came to pass. It took many years longer than I thought it would. If you would have told me it would really start to kick in 2024, I would have given up a long time ago. But every year it just seemed just around the corner. So that we did survive, and along the way of operating that original mine, we were able to acquire 2 more mines, which had similar characteristics: underground geological work done at much lower commodity prices. So we knew there was a huge mine life ahead of it, and entry prices that were really attractive, a very small fraction of the replacement cost or even the construction cost at the time they were built. So great entry points for us to buy. So we did buy those 2. We divested that first mine. And as we came into the cycle, we were left with those 2 mines that we'd acquired. And with Galaxy in particular, the one in South Africa, just starting to ramp up production. So those 2 factors sort of just coincided perfectly. Ramp up in production at the same time that we saw the big move starting in gold price. And that theory that would have profound implications to our operating metrics and our results absolutely came to fruition. And you going through a bit of our Q1 and Q2, you could start to see it already. Very soon, in the next couple of days, we'll have our Q3 results out, and readers can project. Obviously, the gold prices in Q3 being, in our case, July, August, and September being our third quarter, much higher than they were in April, May, June. And so production increase, we've already put out our production numbers for the quarter. Multiply on that the higher gold price and costs staying virtually the same, and you just have this sort of exponential leverage to the upside. And that phenomenon has continued in Q4. We haven't put out our production yet. The quarter's not over. We're just over halfway through it. But higher production, even higher gold prices, and even more of that slice of the pie falling to the bottom line. So that was the key takeaway in terms of like our stock went down. It went down 90+% from when we came public and when we bought that first mine, because gold was over $1,800 when we started, and it troughed at about $1,050. about 5 years after we bought that first mine. So we were battling all the way down, but we kept the capital structure tight. In fact, over that time frame, there was years where we basically had almost zero trading volume. The only buyers were management, in particularly myself. So the result of it, after not just 1 year or one purchase here and there, years and years of buying, and for all intents and purposes, no dilution through big financings or anything like that. The management team, principally me, have accumulated a very large position in the company. In aggregate, myself, one of the directors, immediate family members, and our chief operating officer, also a significant shareholder, own just over 40% of the company. And not one of those shares was like a free share or seed share or anything like that. They were all purchased. We're all up nicely now, but if you went back even 6 months, we weren't. So we've been largely underwater for the 10 years of buying, and now we've, as of today, been proven correct that there was a lot of value in this gold in the ground, in the infrastructure, and the licenses and permits and institutional knowledge that we purchased. And we're now turning that into cash as we're producing that gold. We're ramping up the production, and we're doing it at higher and higher gold prices.
Mm-hmm. Again, loads in there to touch upon. Do you currently have any, what you're describing here sounds like a very full-time position. Do you have any other jobs, any executive or board positions with other companies?
I have a number of other board positions. So I am on the board of a renewable energy company called Abraxas Power. I'm the non-executive chairman of a technology company called Spark Systems. And I'm also a non-executive director of Elemental Royalty, one of the largest royalty companies in the gold space or precious metal space, and notably backed by Tether, the cryptocurrency company. But non-executive positions, and my day job is at Golconda Gold.
So how much of your time goes toward Golconda then, all those other board positions?
Yeah, it would be, usually close to 100%. And some, reporting season, it might dip down a little bit as we have more board meetings, but I don't have an executive role at the other companies. So the only one where I have an executive role, and that's the big draw on my time and my mental bandwidth, is definitely Golconda.
Yeah. What does a mining CEO do all day? I mean, it sounds like a bit of a funny question, but with exploration CEOs, and especially the ones who are geos, it's all about geology, and then also marketing and raising capital, etc. What does a day in the life look like for you, given that you're, again, already generating cash flow?
Yeah, and it varies. So, and I'm not involved in day-to-day operations. We have general managers, we have a chief operating officer, and my background is finance, and mathematics before that. So I'm not contributing to operating decisions. I'm there for governance. I'm there for process. And I'm there for, call it strategic decisions. So how do we fund this? How do we, recruit this person? How do we find the next deal, and how do we close it? Now that we're in a position where we're producing cash flow, we have a market which is interested in gold companies, and we have a really strong story to tell that we have this really massively improving financial picture, and we have a big ramp up in our production, so we can talk for years in advance of growing revenues, growing production. Then I'm starting to spend more time outwardly facing. So I think it applies to exploration companies as well as it does to us, for sure. More and more of my time will be spent on communication to investors, prospective investors, and just market participants in general, whether they be investment banks or other advisors, just looking for what's the next opportunity for us to create value for us as shareholders. One example, which you touched upon, was spinning out our U.S. assets, which is big process, and it's another small mine. Not to anger Mr. Rule too much, but again, it's one that's went through the hard yards of discovery, financing, construction, went into production, and then went bankrupt during the time of low commodity prices. Nothing wrong with the operation or the ore body, and that's one where I could be spending a lot of time 12 months from now working through that spin out. And if indeed at that time, it'll depend on market conditions at the time, if it's really something that's extremely attractive for us as shareholders, it's something we're due. If it's something that's marginally attractive or not attractive, we won't do it. And we can keep 100% of that revenue and earnings inside of Golconda in that case. So it's really just, I don't know what the next corporate action will be, but that's something where I'll be spending my time. And the most probable one, based on what we know today, would be that spin out.
Yeah. And other corporate actions or the potential thereof, we'll discuss as well later on. I do want to talk about skin in the game though, Ravi, and insiders again are noted at 42%. You said it's you and essentially a couple of other guys. How much of that is you personally, and I suppose anyone who's like non-arm's length to you?
Yeah, it just under 30%. So approximately 28%. The other large chunk is director and his family, a non-executive director in that case, and then our chief operating officer would be sort of the third largest camp.
How much of that is reporting, like on your side, like the 28%? Is that all reporting, or how does that?
Not all of it, and a large part of it is in the estate of my father, who's deceased. So at some point in the next probably 100 days, that'll be resolved, and that'll be reporting under my name. Yeah, so that you'll see most of that under my name, but it's still all bound by securities laws and trading restrictions and that sort of thing.
Well, I'm sorry to hear that part that you mentioned there. Well, what's the average cost that you've paid for those shares or other insiders? How did you guys get those shares?
Yeah, most of them were purchased in the market. So probably the highest price that I paid, I could tell you is, the highest price I paid is $5 a share.
Wow.
So which was purchased on the IPO, and that was a significant amount of money. That was $1 million that was invested at the time, 2011. But then there's a big gap. And then I purchased a number of shares from other shareholders that were selling, looking for liquidity at 50 cents per share. And then the lowest purchase would be at 15 cents per share. I purchased a significant number of shares. You can look at the filings. I'm going to say it was 2023. And that was very close to the bottom. So that was me averaging down. The average price for my shares is about 25 cents a share, yeah, which is kind of, close to our 52-week low.
Mm-hmm. You don't often see that high of an insider ownership with companies of your size. Have you found that it's working against you in terms of liquidity or anything else that you might want to solve?
No, I think it isn't unusual, and it's not a criticism of anyone else, like saying, well, you should have higher insider ownership. The nature of mining is it's highly capital intensive, and it's also extremely risky, particularly in the case of precious metals mining due to the volatility of the underlying commodity. You could be flush one year and you could be bust the next. So it's hard for an individual to put a huge percentage of their net worth into actual purchases. If they got it for free as like seed shares, sure, anybody can take free shares. But actually, when you do that for anything that's made the progress, you've had to, had the discovery, gone through construction financing, you're typically diluted to, low single-digit percent, and that's fine. That's just the way this business works. But as an outside investor, of course, you'd like to see more. You see more attachment to the share price performance than to their salary or their bonuses, which is hard to do. In our case, it worked out that way because remember, this is not one purchase. This is purchases over almost 15 years, 14 years as a public company. So it's been dribbled in over time, and really because there was no other buyer for large, like probably about half that time period. Our average trading volume was zero. And it's not because we had a large insider ownership or we had this or that. It's just because nobody cared about gold stocks and especially gold juniors for most of that time frame. So fast forward to today, I don't think it's an impediment at all. It's probably near the top of the list in terms of features or attractions to our company that, I'm not immune to making incorrect decisions by any means, but you can be assured I'm trying to do it for the benefit of the share price. It may prove to be incorrect, but it's not because I'm not making a decision to figure out how I get a higher salary or bonus because it's inconsequential versus, a few cents move on the share price.
I would typically ask, how would you plan on making me money if I became a shareholder today? And then I suppose later on, I'll ask you, how do you plan on making yourself money? And really, where I'm coming from with this, Ravi, is thinking, is there room for more or less ownership? And I mean, your COO seems to have sold a little bit in the market not too long ago, judging by the SEDI filings. Do you expect to see more selling? Would monetizing those shares be part of kind of your personal finance strategy, or how do you look at
In my case, no. And things do change. But I'll tell you that the whole design of this company was meant for me to manifest my view on gold, which, as I joked earlier, if I knew it was going to take this long, I just I would have given up a long time ago, or I wouldn't have done it. But a very strong view on the gold price. And as coming from the investment world, I saw the math behind this is, you could just, probably the safest thing to do if you have a strong view on gold is buy gold and buy bullion.
Mhm.
If you're right, you're going to be right. A more levered, but also fairly safe way to do it is to invest in gold royalty company. Very good strategy. It's just been proven for years and years that it provides tremendous leverage to the gold price, and it's a great way to do it. Then you could buy other gold juniors or majors for that matter, get maybe even more leverage, but take on other forms of risk, operating risk. You're exposed to inflation, all of the different things, management team, honesty or dishonesty. So I set out to design really an investment for myself that was going to give me maximum exponential type leverage to gold price without taking on all sorts of financial leverage. So how does that work? Well, again, going back to Rick Rule line of thinking is, if everybody just set out to buy tier one global assets, then you would only have tier one global assets out there. And guess what? They make money in any cycle. That's great. But let's say you have an operating cost of $1,000 an ounce and gold was $1,500. Okay, so I got a $500 an ounce margin. Now gold's $2,500. Amazing. I've got a $1,500 an ounce margin. It's tripled. But what if I bought an asset which had no margin at $1,500 an ounce because it's small and its operating cost was $1,500, and I could buy it for almost nothing because I had a view that gold was going to go higher. Oh, now gold's 2,000. I got a $500 an ounce margin. Wait, gold's 2,500. I now have $1,000 margin. I've doubled my margin that I had at 2,000. So you have this huge leverage. The other thing that happens, which is somewhat unique to gold, it doesn't happen with coal or other bulk commodities or any other business of running an airline or a car manufacturer, is as you increase the commodity price, which over time invariably happens with inflation, and technology improves, which has just happened consistently for the history of humanity, the amount of ore in any given deposit that's economic expands. It's a non-decreasing function of time. It will expand faster than you can mine it. So with gold at 4,000, as we sit here today, versus gold at 2,000, the in any ore body, there's going to be all sorts of ore. Now you have, instead of having a 5 or 10-year mine life, maybe you have a 20-year mine life, albeit at lower grades, but at higher commodity prices because the technology has improved and the price of the commodity has improved. It's changed everything. So that asset you had, not only did I have optionality on the ounces that were already there, my number of ounces just increased. So I really have exponential upside on that. And that's Galaxy is a great example. So this was something that was broke. It couldn't make money. When I bought it, gold was below $1,100 an ounce. I didn't pay very much for it. And I had about 1 million ounces in all resource categories. I recut the same resources at, I think it was $1,700 or $1,800 gold about 5 years ago. And it went from sub 1 million to almost 2.5 million ounces. If we redid it today without any expiration happening, it'll be up another number. I can't say wouldn't be a compliant number, so I'm not going to say a number, but it'll be higher, obviously, at the much higher gold price. So while I already had millions of ounces, I would have a lot more ounces. And that will continue to be the case. So you have this huge upside. So I designed the company very much on the basis of creating an investment for myself. And by extension, anyone else who wants to manifest a view on gold price. And And to me, I'm doing, as my exploration budget is basically zero, and it has been for years, because I have, decades of mine life ahead of me in my operation. So I don't need any more ounces. I love more ounces, but it's not going to affect my mine plan in 2025, 2026, 2027, 2028. So I'll do it opportunistically, when it suits me. But as of now, I'm focused on turning those ounces into cash. And that's a way for me to, well, first of all, I've delevered financially. I can say, as we've made public statements about it before elsewhere, we're now debt free on a net basis, and we'll be really cash additive for 2026 at these gold prices. Don't have any more debt to repay. So, you talked about how we actually had less free cash flow falling to our bank account in 2025 versus 2024, even though we were generating more. Great observation, but it was put to productive use. It was going into capital expenditures, and it was going to retiring debt. We just didn't have enough of it in 2023 or 2024. Now we had excess cash flow. We were able to productively redeploy it. 2026 and beyond, the capex that we need to continue to make to continue to grow the operation is tiny compared to the amount of cash that we're generating. So that's, you posed a very simple question, is like, how am I going to make money for you as a potential shareholder, and myself as a larger shareholder? Is I'm going to continue to more of the same, but now I'm very much in the mode of turning those ounces in the ground into cash. And, the rising tide floats all boats, for sure. You can buy anything in the gold sector. If gold goes up another $1,000 an ounce, almost every single thing you could have bought will have gone up, and probably a lot. Mm-hmm. But in my case, 365 days a year, my financial situation is getting better directly. It's on the balance sheet that cash is going up, whether I'm reinvesting it or I'm just stacking it up in a bank account. I'm benefiting directly from that gold price, and I'm super levered to it, because I'm getting more ounces, I'm getting more mine life, and I'm getting more margin for every ounce that I produce.
Well, you though, personally, as a person, you're benefiting directly from it on paper until you sell. So how are you actually going to make money? How are you going to turn shares into money? Is kind of where I was going with that question.
In my case, until something fundamentally changes, I don't want to. So this is my investment in the sector. I think we're in a financial position, having been successful as a money manager. In the first half of my career, I have no liquidity requirements, so there's no need for me to sell even 5% or 10% of my position at any point. So it's really, I'm like, how do I continue to manifest this as my investment in gold? Why am I so convinced on it? That's a whole discussion and interview unto itself. But it's really a view that we the fiscal situation, the monetary situation globally represents an intractable problem. There's no plausible set of inputs in terms of growth, productivity boost, austerity, intersection of all of the above that can get us out of this debt puzzle that we find ourselves in. It's just not, there's no plausible set of inputs that gets you out. Right. The only path forward is a complete financial reset. And then the question is there a neutral reserve asset, as there has typically been? And what is it? And in my view, it's less clear than it ever was. If you go back thousands of years in human history, even going back anything pre-1971, there's one answer, it's gold. Now, the answer is not as clear as it once was. However, I do recognize that central banks own trillions of dollars of gold and continue to buy it. It is the most logical neutral reserve asset. And in any reset, and I don't know exactly what it would look like, in any reset, the gold price in paper dollar terms is definitely going to be higher, and probably much higher. And that's what I'm around for. Mm-hmm. And in my view, it'll be another sort of fundamental transfer of wealth. Like those who it's not going to help most people. Hopefully, many people listening to you today and otherwise are going to be very well positioned for that. But for most of the populace, it's going to be another, separation where the 1% become even more wealthy relative to the 99%, perhaps unfathomably so, as owners of real assets, businesses that are inflation protected, or even indeed gold or gold related businesses. So that's a very long view on my part, and that's where I'm positioning myself.
This is all again about skin in the game, though, and trying to figure out what drives you and the team. And again, particularly interesting because in your case, it's different than the usual company that I interview, which would be an exploration or development company, because they don't have revenue. So for you, what is that? What are the KPIs for determining how much money you make, including salaries, bonuses, share grants, and what are the conditions under which you and the team get incentivized?
Yeah, that's a great question. So, like I said, personally, I don't care very much about my compensation on an annual basis. It's inconsequential relative to the value of my ownership of the company. Obviously, it is much more important to everyone else working there. And we have a detailed set of KPIs for our senior management team, sort of C-level people and manager level people, which are geared around production and safety. In our case, we are a production company. There's no exploration aspect, and it's not very capital markets focused. And the thinking there is our business is if somebody's showing up and purchasing our shares because we convince them to or otherwise, or they've looked at our results or otherwise, they're going to do well or not do well if we do well on our production. So if we have a great resource base in front of us, we already have that. We have sufficient infrastructure. It's management and execution. So all of our KPIs are geared around that. One thing I can share, which has been, I think we can say with hindsight, extremely successful, is we've introduced monthly production bonuses around hitting and exceeding budget. And we've paid out most months in 2025. And it's a small beer in terms of the sort of overall financial picture of the company in terms of what gets paid out. But it's a big number in terms of cash paid out to our average employee. And what it's translated to is motivation, pulling everybody to start thinking about budgets and monthly targets and meeting them, working as a team. It's also because it's paid out, it's actually been financially motivating for people, and people are in a better mood, and company morale is the highest it's ever been. So it's like I said, that was I could say with hindsight, thus far 2025, it's been a success because just everything that we were hoping to achieve with it has been achieved. And any negative would be like the amount of cash that we're paying out, and it's small compared to the impact that hitting our budget and in some cases exceeding it translates to for our actual financial performance.
Again, morale is something that I don't think I ever think about when it comes down to exploration companies because there's 3 people working there and they don't ever see each other, which is different in your case and something you do have to think about.
And these kind of things are, they're challenging in all types of markets because when you have a trough and there's a lack of jobs in the mining industry, typically the payouts and the salaries are lower. There's downward pressure on them or a cap because there's lots of people available and nobody has money and people aren't growing. And so you have to work hard to keep people motivated. But in this kind of environment, stock prices are up. There's lots of jobs, salary, the upward pressure on salary. Your challenge as a manager is like you got to keep people, and they got to. For those who stay, some people may never leave because their family is close to the operation, or there's some other thing tying them there. But you still don't want them to be unmotivated. So, having these structures in place, I think is really important in all types of market conditions.
Mm-hmm. On the topic of insiders, Ravi, do you or any of the other insiders personally own a royalty on any of the projects that you have?
No, that's a personal red flag for me looking at any project. If you have an insider and I've heard every possible explanation as to why that had to be or those royalties came about, and no, there's nobody within 7 degrees of separation that owns a royalty on any of our properties.
Within 7 degrees of separation, would that mean there's no royalty at all?
We would not do something like that.
Yeah. No. I do. There is a stream on it, so we will talk about that as well. But I think this about does this for the smell test. I want to move on and talk business strategy here, and eventually follow up a little bit on what you told me at the beginning there when I asked you about the Rick roll thing. But is the idea for you as a team to stay small and kind of or grow toward, when I say small, I mean anything that's not a major? Or would you be maybe hoping out for a takeout before that? Or do you have something entirely different in mind?
I'll preface my answer by saying everything I've started in my life, including my own fund management company, I started with the concept that I would be running this forever, and I'd sell it when I die, kind of thing. And every single thing I've joined or started, I've ended up selling. And I can say it was been for the right reasons all along. It's been the best deal for the owners, shareholders, employees in all cases, and it was the right thing to do. So if you ask me sitting here right now, I'd say no. I'm going to be here till I die, and I'm never going to sell the company. But that's totally not true. Like if it's just going to be a response to market conditions and what's presented to us. So at some point in this cycle, even if we don't do anything else, and we just have the two assets we have, it might be two different buyers because we have two very different geographies, even though there's a lot of similarity between the assets from an operating point of view. The geographies are naturally quite different. There will be a bid for each of them. So we'll just look at the situation and what the prospects are for gold and what growth's ahead of us and what price is presented. So never say never. It is possible. Back to your original question is, what's the strategy? Do we want to stay small or do we want to get bigger? The answer is neither. So I don't care about either. This is an investment decision for me. And I want to see the share price go up as much as it can. And so the metrics that I'm looking at is cash flow per share, free cash flow per share, because things like taxes and minority interest and CapEx matter. They're real numbers. I can't spend EBITDA, but I can spend free cash flow, net. So that's something I look at on a per share basis, because even with the existing operations, there's decisions that we could make now that could result in higher production, and maybe the world's moved on. Say, oh, we're not chasing ounces of production; we're chasing value. There are decisions we can make which would result in a higher NPV. But what about NPV per share? What if I have to dilute to get that higher NPV? What if I have to dilute to bring that production forward faster? So I've created a larger NPV, but what did it do for me? If it's not higher on a per share basis, then I shouldn't do it. So and maybe like say, well, it's myopic, Ravi, because if you get bigger, you'll get more attraction to other funds. You can get added to an index. All of that is absolutely true. And I'm sitting on boards where those things are being discussed, and it's not wrong. But in this case, we don't need to access capital. So I'm not as focused on those things. I'm focused on what is my free cash flow per share. What is my NPV per share? Not what is my NPV, what is it per share? And what can I do to increase those? If I buy back shares accretively, then I'm increasing both of those. So that's always something I'm thinking about, and how can I do it, and when can I do it? What price do I do it at? Would I take on another project, an acquisition? Absolutely. But the metric I'm going to be looking at is going to be free cash flow per share and NPV per share. And it's you can bet, again, I'm not infallible. I do make incorrect decisions like all of us. But at least you'll know what I'm trying to do is increase those numbers on a per share basis, not just on a gross basis.
Mm-hmm. Kind of like you, I'm not infallible. It means I'm just basically infallible all the time.
We're fully fallible.
Yeah, exactly. No, jokes aside, though, someone recently told me that if you build it to sell it, you'll be forced to run it, and if you build it for cash flow, you'll be forced to sell it eventually.
That is a great line, and I'm going to reuse that. But and I'll give. Sorry to interrupt you, Antonio, but I'll give you an example of a renewable energy company that I was chairman of, and we labored away for years. We had way too much debt, but we saw the projects were becoming online, and so we hung on for dear life, just kicked the ball down the road with just the same stuff that we did with Golconda, and extended it, and nobody foreclosed on us. And one by one, we paid off all of our debts. And at the end of it, we're generating all sorts of free cash flow. So high five, hallelujah, we did it. And basically immediately our shareholders wanted to sell the company. In my case, I questioned that decision. But with the benefit of hindsight, it was the right thing to do. We got over 100% premium for the shares in that case. But that's exactly what happened. When we got to the case where we had lots of free cash flow, it was a very saleable asset, and it was hard to hold.
Mm-hmm. Yeah. Oh, that absolutely makes sense. And it also makes me wonder, though, is there really a market for M&A for companies of your size, or where you want to get this company, or would you have to be bigger for a potential takeover? Like, is there appetite? Is there demand for companies of this size?
So if 6 months ago, no. A year ago, absolutely no. And starting as of today, yes, there is. So I could say, we've been approached on both of our assets with not unreasonable bids that I would never consider selling into. Price is just way too low versus the prospective value of those operations, but not ridiculous numbers. So there is in this market for sure because of that cash flow potential. So in the case of Galaxy, we're on the other side. Like we've done the hard yards, we've done the rehabilitation, we've gone through the money losing years, and now even funding our growth capex, we're generating tons of free cash flow along the way. So there are lots of people who would love that as a part of a piece in their puzzle for sure. And just with the same token, we would be looking for something like that. We would look to buy that if it was the right price. For slightly different reasons, our assets in the United States are also attractive to people. They're not the kind of assets where a Barrick or Newmont's CEO is going to roll out of bed and say, I need to buy Summit Mine in New Mexico. They're just too small, and they're not the kind of assets. They're not tier one global assets. So they don't have that bid. But asset that's going to be in production in 2026, gold and silver producer, high grade, profitable, fully permitted in the United States. Yes, there's a bid for that. And there's aggregators, deal guys, all sorts of people around the table. Fast forward another 12 months or 24 months, what I think that you're going to see mania type conditions in the precious metal sector. Think 1990s.com kind of frenzy around it. It sort of started to kick up as we broke through 4,000, and it's gotten a lot quieter, and which is really constructive. But we're going to see that kind of frenetic level of activity and almost panic or euphoria type situation. And there'll be even more interest in those kind of marketplaces. And look, like I said, I'm not afraid to sell stuff. Everything I've started in my entire career, I've ultimately sold. So I wouldn't take it off the table for Golconda or individual assets for that matter.
But the normal intention here for you remains, as you said, cash flow, generating and building out cash flow per share. What do you think will be the biggest challenge in that process? A bit of a broad and an overdone question, but it is going to get us into talking about some of the specific challenges. So what keeps you up at night the most?
HR is a factor. So in the case of Galaxy, we have a high degree of dependence on a small number of people who are beyond competent. They're absolute masters of their trade. So in some cases, just retirement and aging out. In other cases, it's competitive bids where you say, well, if somebody's really valuable to you, you should pay more to keep them. But if you have a salary structure in your company of X, Y, and Z, different levels, you are somewhat constrained. Like you can't pay one guy 3 times as much as the next guy just because you got a premium bid from Newmont for some big mine somewhere else kind of thing. So that HR is where it's in, like I alluded to earlier, for different reasons in this kind of market, a hot market, your HR is different. You have to create an extremely high morale, positive workplace with growth opportunities and financial opportunities, sure, and try and keep those good people. With Summit, we have a different kind of exposure there because we're just staffing up. And it's a small mine in a relatively remote, but it's in the United States, but it's a remote part of New Mexico. So staffing and trying to get really high quality people is definitely a challenge, and then retaining them in a market like this. particularly in the US, where you got kind of a mining boom that just hasn't happened in my lifetime. And maybe you have to go back to sort of World War II and the mobilization effort for the war to see the kind of capital that's forming and interest that's forming in domestic mining in the United States. So that's going to be if it was like when I look at my spreadsheet in the morning and my to-do list and the stuff that's where I'm sort of gritting my teeth a little bit about, it's mostly HR. If you would have asked me a year ago, I would have had a different set of answers. And that's because we hadn't crossed the chasm yet on Galaxy in terms of going from, trying to fight our way out of the situation where we were undercapitalized for so many years and execute the ramp up in production at the same time. We're on the other side of that now. So we've paid off our debt. The risk to us, or the probability of us succeeding on the ramp up that was on our spreadsheet and in our projections, is way higher because we don't have a sort of debt sitting on us and any financial concerns. I'm like, okay, we were off by 20% of the capital expenditure for that. Just spend it. We have to spend it. So it gets done. We'll make it up somewhere else. Those kind of conversations were not happening a year ago or 18 months ago because we didn't have that kind of financial flexibility. So that was a very different moment in time. Also, a year ago or 18 months ago, with respect to Summit, we still weren't sure how we were going to finance it. Small mine, okay, it's in the United States, more people at the table, but crickets for the most part. Then, starting about a year ago, tons of interest started flowing in, people contacting us. We weren't reaching out to them. And then fast forward to November 2025, we're making enough money at Galaxy. We don't even need to borrow money against our existing credit facilities to fund the restart at Summit, or just do it out of free cash flow. So again, not only is that take away the financing risk, it really lowers the execution risk because you're sort of going into it with a less, okay, everything has to be perfect. If we're off by a budget by 20%, then we're gonna have to raise more money or find that money somewhere else. We're good. So we're going into with like a lower stress, lower anxiety level attempt at getting into production, and it has a much better probability of success as a result of that.
And mining is in large part about uncertainties, right? And it's about managing uncertainties, really, and it's about managing probabilities as well. And to that note, at Galaxy, you're operating on resources and not reserves. A big chunk of the resources are also inferred, and this is a vein system, which underground vein continuity is not always as predictable or as straightforward. So do you see that as a potential risk? And do you think you might have to upgrade that? And is that something you would be, working to mitigate?
So then the point you made is a very subtle one, but it's absolutely on point. So we are in greenstone. So there's a high degree of variability, width of the ore bodies, grade, other metallurgy of the ore bodies is moves around depending on which one we're in. And so you can't do anything about it. You could drill more and you still struggle to upgrade the resource. Of course, you'll get more and more refined view of the ore bodies and your planning will be better. But at some point you have a law of diminishing returns kicking in. So we were at a point when we started production at Galaxy where we could say, hey, this thing has been producing in some shape or form since about 1880. So there's gold here. We know the grades and they're going to average something like this. And we took the appropriate discounts in the resource statement to reflect greenstone and the amount of drilling definition that was in place. It's quite high discount levels applied. And we had an economic model. So what's now, here we are again, end of Q3 and into Q4 of 2025. We've been mining in two key ore bodies, Princeton and Galaxy ore body, and we've consistently tracked well above plan on grade. So what does that mean? Does that mean the ore bodies are better? Not necessarily. The ore bodies are more or less what we thought they were. And the issue was we had to plan based on a compliant resource, and there's like a lot of discount factor put in there because, again, the greenstone, lack of drilling definition. And so it tells me with the benefit of hindsight, the person doing the resource report did an appropriate job because we've consistently erred to the positive, to our favor. which if it was going the other way, that means they've done something wrong. It doesn't mean that they were light on the numbers. It means that they were applying appropriate discount factors because of a lack of data and the nature of the ore body being a greenstone set of ore bodies. Mm-hmm. So that is a risk that is, you cannot remove that risk. What can you do to mitigate it? Well, it's the same thing that we're doing to ramp up our production. So for the last year plus, we were at two faces, Princeton and Galaxy. For the last several months, we're at 3, Princeton Top, another part of the Princeton ore body, and Princeton and Galaxy. We're adding a 4th face, which we refer to as 26th level. That's a bottom access to the Galaxy ore body. So we'll now be mining at 4 faces versus 2 a year ago. So what does that do? It means when it's just portfolio theory, right? When we had one of those faces, the grade dropping because the tons dropping because the ore body pinched and it was more narrow, or for whatever geological reason the grade dropped for that week or 2 weeks, then the probability is that's not happening at the other 3. If you have only 2 of them, you're much more sensitive to it. Now, when you have 4 faces going at 4 different locations and one of them pinches or grade drops, it's going to average out between the 4. Fast forward another 3 years and we're at 6 or 7 or 8 faces, and you've widened your portfolio. Portfolio theory again kicks in, and your exposure to those risks, they're not just risks, they're just facts that's going to happen. It happens to us every month. We have some week where we have below plan grades, and it just is what it is with the nature of the ore bodies we're mining. So we can't eliminate the risk. We can mitigate it by expanding and diversifying even within our own mine.
And to that point of expanding, as well as with production, and I know annualizing in the mining space invites a lot of assumptions and potential problems, but looking at what you produced in Q1, Q2, and again, those Q3 numbers that you mentioned, at least the production numbers I do have here, so respectively 2.9, 3, and 3.6 thousand ounces. Annualized, that would be in the, call it 13,000 ounces range. That is still a lot of work to get to that 40 plus, was it 43 or whatever thousand ounces that you had envisioned at phase 2 of the Galaxy PEA. When do you think you're going to get there?
So we can't rush perfection. So it's the nature of the mine that we have and the asset we have. We have to follow through with the development in the ore bodies that we have. We're leveraging the infrastructure that we inherited. So one subvertical shaft, various adits that we've added over the last couple of years. And that mine plan that we've developed takes us out basically over 5 years and gets us up from what we'll have averaged this year, about 10,000 tons of ore to our plant monthly, up to 40,000. It's not linear. We got a big step up. You can see the run rate in Q3, and a few months later from now, you'll see what Q4 looked like. And we'll have a bit of a step function because we added a 3rd face and shortly a 4th. So that gets us to a higher production level for 2026, 2027, 2028, somewhat incremental in terms of tonnage, no big step function up. And then 2029, 2030, we have the next step function up, and we get closer to that 40,000 tons per month sent to our plant. And that results, you could, more or less turns into 3 to 4,000 ounces per month. So that gets us up over that 40,000 ounce a year target. And what's the limit to, why can't we just do it faster? I mean, there's a physical limit in drilling and blasting. Like if you had unlimited number of faces, you could be drilling and blasting, at the same rate at all those faces. But we have a certain number of faces, and you can only blast certain and remove so much ore out of each of those faces per year. And we have this layered approach to get up to access to the ore bodies and get that tonnage up. One big positive for us is that we put in most of the capital expenditure on the processing side up front. Why did we do it? There was diseconomies of scale to put in smaller capacity. So our mill can handle all of that already. So we don't need to expand that mill or change that mill for a very long time. Other aspects of our plant don't have the capacity to go to 40,000 tons a month, but the smaller capital expenditures, incremental things that we're going to do as and when over the coming years. And we're talking hundreds of thousands of dollars of capital expenditure, not millions or tens of millions. So we're in a really good shape on the processing side. And we're in good shape on the mining side too, but we just can't rush it. I mean, it's going to come at the pace it's going to come. Drill, blast, produce, and open up new faces over the next 5 years.
Talking about those challenges that we talked about earlier in terms of HR and whatnot, what about operationally? What's been the biggest challenge in ramping up so far? I mean, availability of equipment or labor or weather or I don't know, something else entirely?
By a wide margin, in our case, availability of equipment. And so, and availability meaning, I should say, equipment availability, not availability of equipment. I'll clarify that. So we are dealing primarily with manufacturers in South Africa, and it's the home to mining for many vendors, and source of great equipment for decades and decades. The mining industry in South Africa is still contracting, even with the boom in commodity prices. So there's no, for local equipment, there hasn't been any real pressures on getting in, like blown up lead times or having to put big deposits to get in the queue to get equipment. So getting the equipment is actually pretty easy. In our case, we've had problems with equipment availability as operators, and sounds like something pretty simple. Why have you had that issue? So the levels that we're shooting for in our budget, I would say, are well below industry norms, and they're below what we're going to get at Summit in New Mexico. They're well below what we got just over the border in Botswana with our previous mine that we started the company with and subsequently divested. Why are they lower? It's a function of how we got through the dark days in the gold industry. So we bought refurbished equipment. We ran equipment for much longer than we should have. We were very opportunistic. We got, this piece of equipment here, that there, paying pennies on the dollar, and just held it together with duct tape and crazy glue for many years. So what does that mean? Instead of having, like most mines would have, say, 2 or maybe 3 vendors, which means you're stocking spare parts for those 2 or 3 vendors. It means you're training and hiring your mechanics based on those 2 or 3 vendors and expertise on those. We have like 7 vendors. So we have much harder to keep critical spares, much harder to specialize your mechanics and your maintenance staff to maintain them. And so more mistakes, less capability on that front. And, our starting point was, for the most part, refurbished and used equipment. So, of course, from the get-go, the availability and the performance is going to be lower. So that continues to be probably our major impediments operationally. And what we're doing to fix that is, now that we are in a better financial position, we're starting to normalize, and it's a process. You don't just go out and do it all at once. We're starting to normalize to 2 vendors. And we've ordered equipment both on the development front and the production side, and some other support equipment as well. And that starts coming in 2026. And 3 years from now, all that old, used, and refurbished equipment will be gone, and we'll be down to a couple of vendors for all intents and purposes. So we'll be able to specialize our training that we send our mechanics on, and we'll focus on it from a hiring perspective. And it'll get better and better, and we will get up to industry norms there. So big opportunity for improvement for us, because we're coming from a very low performance currently.
Mm-hmm. Well, financially, that's interesting as well. You talk about exiting 2025 with net cash and no debt. So it seems like, again, any fires of the past are now well under control. But are you now at a point where you can be consistently profitable going forward, even, again, accounting for challenges in the volatility of the mining business and everything? Or do you think it would take more work to kind of solidify that position?
We should be consistently profitable. There'll be some variability on quarters based on grade and where we are in the ore body and that sort of thing. However, we're just ramping up on our tonnage so much over the next several years. We should be at least growing a little bit every quarter. And then our profitability will move up and down with gold price. But where we are now, even though we're still a very modest sized producer, we're we're profitable probably down to close to $2,000 an ounce. So covering soup to nuts, everything in there. And by profitable, I mean also covering our actual capex too.
Yep.
So that's we've got a lot of buffer in there. We'll be consistently profitable. It doesn't mean our profit won't go up and down with gold price, though, of course.
I promised to talk about the stream. Do you feel like the Empress stream here, which quickly I think they receive 3.5% of payable gold at 20% spot, and that's up until 8,000 ounces, and then it goes to 2% up to 20,000 ounces or 20 years, whichever comes first. Do you feel like that needs to be out of the way for Galaxy to be, pardon the pun, in a rock solid situation here?
No, it's so first of all, I was very sad. Nothing negative to say about the Empress people, but sad to have to do that transaction because I just had such a long-term view on it, on the asset and its potential, and we were so close, but there was no access to capital for us. So that wouldn't have been horribly dilutive at the time. So we very much needed that to do that transaction with Empress. It was important to us, and it really was kind of the turning point that set our production back on track and got our growth back on track. So that was critical money for us to take. Gold was at about $1,800 an ounce when we signed the deal with Empress, not that long ago. And at that time, it would have oddly been more of a burden on us or it was more of a burden on us to service the stream because we just have less revenue and cash flow available to deal with it. Now it's more expensive because the numbers are bigger. The ounces are the same, but the numbers are much bigger with $4,000 gold. And it's a much better deal. It's a fantastic deal for Empress. I think probably within 36 months of the investment, they'll have got all of their capital back, which is not a normal kind of return profile for a stream. So I'm happy that they're going to do extremely well from it. It was very important money for us. We wouldn't have been here without it. But I think it's just part of the model now. So it's going to be there for 17 or 18 more years. And it's just a cost to us. So that's just part of our operation. So I don't think it's a monkey on our back or anything that's really holding us back from perception wise, or certainly not operating wise.
Mm-hmm. I think your dog might disagree with that, though.
Yes, he had a few words to say about it. He didn't like the stream either.
Yeah. But non-negotiable though. I mean, there's no way for you to buy it back or do something like it's there, it stays there. There's nothing you can do about it now.
There's nothing we could do except for, we could probably negotiate delivering ounces to them earlier. But buying it out, no. I mean, it's a fantastic asset for Empress. And, it gives them exposure to gold price for years to come. And, they'll grow with us. Within the context of the maximums on the agreement, but they'll grow with us as we grow production and the gold price goes up.
Mm-hmm. I think you also become fully taxable sometime next year. How much will that be in percentage, and what kind of effect do you think that might have on your bottom line? And when I say bottom line, for the record, I'm talking about free cash flow per share.
Yeah, it's a major consideration. So because we started 2025 with approximately $29 million US of tax pools. So we do have to pay some sort of, you could call it a minimum tax that we have to pay, even if you have historic tax losses. But those tax losses are good in South Africa; they are preserved, and we've whittled through them at an unexpectedly fast rate. So we thought those would be there for years to come. I expect we'll have burned through all of them before the end of Q2 next year. So what does that mean for us? It means we'll start paying 35% corporate tax in South Africa. So that is a pretty big change. And if you look at our projections that we put out to markets, you can see our production going like this from 2025, 2026, and the cash flow just kind of going sideways a little bit. And the natural reaction is like, what's happening to all the extra money? Where's it going? And the main place it's going is additional taxes. So it just is what it is. It means like all the historic money that's gone in, that was preserved as tax losses and operating losses, it's now been recouped. and it's a truly profitable situation. So taxes must be paid. Are we looking at other ways that we could sort of bring forward expenditures to, that's going to pay off for us in a big way, because we would be avoiding that 35 cents on the dollar of tax in 2026, and that bringing the capex forward, or in a way that saves us that tax money is somehow pays off faster. Where in fact, we have a meeting in a couple of weeks internally to just go over exactly how we might do that. But the reality is, we're profitable. We're going to have to pay corporate tax. There's no escaping it.
Right. It's we also didn't really talk about BEE, but it's 26% that goes to them, right?
That's right. So that's another factor. So as there's the tax losses and going through tax pools. We also have intercompany debt. And you could say the origin of this is, top company has put money into the operation over the years to get it going, funding salaries, funding capex, funding operating losses, all that sort of stuff. Some of it historic, some of it put in by ourselves as Golconda. Mm-hmm. And also in 2026, that will all be paid back. And so Black Empowerment is, trying to get ownership into the hands of previously disadvantaged individuals and communities in South Africa. It's a program that's been around for decades, and it's not a totally free interest. They don't just automatically get 26%. So all the money that's gone in is coming back out with interest, and they could get into the chips sooner if the Black Empowerment groups put up the money, actual cash money. But in our case, we don't need any money. So all that intercompany debt gets paid off with the intercompany interest. That will happen before the end of 2026. And in which case, then to take additional money out of the operating company in South Africa, would have to do it. We have to pay our corporate tax, and then we pay a dividend, and we're also going to be paying part of that dividend, 26%, to our Black Empowerment partners. In our case, the key partner that we brought in is, the partners are community trust, so basically employees and people in the community, and then a microfinance institution that funds exclusively female entrepreneurs in our community. So hopefully there's like a big positive knock on in terms of social license and, again, morale and just sort of general positivity in the entire community. So it's not money that's wasted. It's money that's productively invested into our community and hopefully pays dividends, not just for the community, but for us as employers and operators in that community.
Mm-hmm. So it's 26% to BEE, 3.5% stream to Empress, the taxes on top of that. And so where I'm going with this is, I guess I'm going to ask a very wide question here and invite a lot of assumptions and forward-looking statements here again. But what gold price is too low for your operations to be that in that rock solid formation of profitability and positive free cash flow per share that we talked about?
Well, I think you'd have profound implications for our share price at even better prices, but round numbers, it's around $2,000. So remember, as the gold price goes down, the profitability goes down, the impact of royalties, BE, taxes all go down commensurately. And then it really comes down to operating costs. So where does their operating costs and then capital items, everything across the entire business, where's the sort of the line? It's a moving target, but push 1, 2, 3 years out, and it's going to be close to $2,000 an ounce. So that's kind of like where, the company's viable. We'll keep going and we won't have to raise money or anything like that, but we're not generating a whole lot of free cash flow.
Mm-hmm. Yeah. That makes sense. And hopefully we don't have to worry about that with gold where it is right now. I'm still on topic of thinking about what potential challenges there might be in the process of ramping up production to that 40,000 ounces Ravi and above. And so based on what you've told me so far, what about concentration risk? Because again, you're potentially looking to spin out an asset in Q4 next year. So by the end of next year. So being, for most intents and purposes, single asset producer, is that a risk you're going to be looking to diversify away from?
It is a risk, and it's not, again, I'll be completely bottom up and not top down or macro on this, saying it is, being a single mine operator is super risky because you can have some sort of accident that'll interrupt your business for potentially a few months without anything going catastrophically wrong. That does happen in mining, and you're really exposed if you're a single asset company. Which, while we still have two assets right now, we're still a single asset company in terms of production base for sure. So that is a risk. We recognize it, but it's not driving our thinking, saying we got to go out and buy something else because we don't want to be a single asset company. I'm completely bottom up. If there's like an opportunity that's screaming, hey, this is going to be accretive to you on an NPV per share and cash flow per share basis, buy me or figure out a way to make a deal. That's something we're looking at 10 times out of 10. But we're not rolling out of bed saying, we got to diversify and figure out how not to be a single asset company.
Do you have part of it is asset risk, but the other part is also country risk? Do you have a preference for a country, or being completely bottom up means starting at the asset level again? So if you found something that is in South Africa, would you still go for it, even though it wouldn't really diversify the country risk?
Yes, we would. And why is that? So offsetting that, you're concentrating your jurisdiction risk further, for sure. I have a high degree of comfort in South Africa. I mean, it's we have this black empowerment issue or factor, I should say. It's not an issue. And you have a lot of more noise and I think a negative perception around South Africa versus many countries in Africa. It's wrong. The perception is wrong. There's decades in the post-apartheid era of history that are behind us now, and substantially no major issues in terms of stuff coming down from a jurisdictional, like federal government or provincial government kind of issues. The real issues have been bottom up, being employees. As these operations have gotten deeper, they employ more and more people. You got to negotiate with unions. You have higher and higher power costs, dewatering costs. So they've been South African mining has been plagued by being the victim of its own success over many, many decades or even centuries, I'll say, and really more people type issues on a community or mine specific level, not big macro issues. I worked in the Congo. I worked in Liberia. I've had exposure as a director or investor in companies all over Africa. I think I've been to about 15 countries in Africa myself. And it's like you're in a different planet when you're in South Africa. So when you're in, say, Congo, you're worried about how do I get my equipment in? I'm going to deal with corruption, getting it in, theft, logistical issues, huge costs. Where am I going to get my people from, my expat staff, all sorts of these kind of very logistical questions. For most cases, your equipment, your people, your everything is coming from South Africa. Well, we're already in South Africa, so we're not sourcing stuff from all over the world. It's all locally supplied. We get, I land Nelspruit Airport, which is an international airport. You can go one way, you go to Kruger National Park, one of the greatest experiences anyone could have anywhere in the world. It's an international tourist destination. And about the same distance in the other direction, you get to our mine. On sealed roads, you can stop at McDonald's or KFC or go to Massmart, which is their equivalent of Walmart. All that stuff's in the town, all 15 minutes from our mine. We have grid power. There's beautiful trees and foliage, almond plantations, macadamia plantations, beautiful mountains, stunning part of the world. We're not sitting there worried about, how are we going to get this equipment in? There's no road, there's no port. It's got to come in from such and such, and then we're going to get stuck with import duties. None of that applies. So from an execution operating point of view, South Africa is on a planet by itself. Number two, I told you my biggest risk or concern is HR. I can staff stuff in South Africa. I already have an existing team. There's going to be synergies if there is something comes up in South Africa. When we bought Galaxy, our home base was Botswana, Francistown, Botswana. It was about 6 hours drive from Galaxy. So for guys trying to start something up, to be able to share your senior resources, whether it's mine planning, geology, maintenance, engineering, you can do that with mines that are that close to each other. So I would have that advantage in South Africa and nowhere else. So for sure, I would consider something again in South Africa if it checked all my boxes. And I wouldn't be afraid to concentrate more on South Africa. It's a factor, but by no means is a deal killer. In fact, I would say it's more of a feature than a deal killer.
Well, I suppose, yeah, South Africa is probably better than, well, definitely better than most African jurisdictions, but still not risk free, though. Really, where I was going with this or thinking about is how do you see political risk here, especially in a world of $4,000 per ounce gold, right? And could there be additional royalties or windfall taxes or anything on top of that would essentially make your life harder?
I think my prediction is all of the above. So I think that's how this cycle may hit its first major speed bump is if, in fact, specifically if gold's remonetized and it becomes officially a neutral reserve asset again. But even if it doesn't, and it seems like the perception is, and the world's heading that way, and we continue to have higher and higher prices, it's too juicy a mango sitting there for governments to not want to take a bigger bite out of it. And the smarter governments will do it by a windfall tax or perhaps higher royalty on gold production, and as opposed to trying to nationalize or steal assets, because then you have to operate it. That's the worst thing in the world. But just take a bigger bite out of that juicy mango. So that's in the cards. It's going to happen. But guess what? That'll happen in Canada, the United States, Europe, everywhere. That's not going to be an African problem. It's going to be an everywhere problem.
Hmm. That's actually an interesting take. They could make a podcast in and of itself as well. What about power? Where does your power come from? What's the situation there? Have you had any down days and so on?
So we've had a remarkably easy time with respect to power. So we're on grid power. Uh, South Africa has a serious and growing power problem. And so years of underinvestment combined with years of demand growth, deterioration of legacy investments, it's only going to get worse in South Africa. So we've been very fortunate. The area we're in, we haven't had any issues. We haven't been subjected to blackouts or protracted unexpected power cuts. So we've been fortunate. That has not been the case in other areas of South Africa for sure. Coming into 2026, something that's on the table for us is figuring out how to internalize a lot of our power requirements. So we're in an area that's a high quality area for solar radiation. And we are free, I believe we own 980 hectares of land freehold. So we have a lot of space. Most of it's hilly, mountainous kind of area, so not suitable for solar. But there is definitely a plan there that is slowly coming together where we can internalize our power requirements, which will have a very quick payback. Just back of the envelope, it's sub 18-month payback on capital expenditure on solar. So super accretive to us to do that. And so it's something that we are going to do. It was by no means in the cards a year ago or 2 years ago, but now looking at the cash flow generation, it's a great opportunity for us to save a lot of money for the operation and de-risk it because that is coming for us. We've been fortunate thus far.
What about water? What's the water situation? Where does it come from?
Too much, yeah. So we have no shortage of water. So we're pumping water, and there's actually maybe the only mine in the world like this. There's a beautiful waterfall that falls over the main adit to our access to our mine. So there's a lot of water where we are in Mpumalanga province, and that's not. If anything, there would be too much, but we don't have. So we've made some investments to make sure that water is pooled and routed away from critical infrastructure. We have had issues in the past, and so we've taken the time to make some capital investments to make sure that we don't have water affecting us, but no shortage by any means.
Skilled labor and specifically for underground mining. I know it's mechanized cut and fill in your case, but still, where do you find skilled labor? Is there plenty in country? What does your breakdown look like in terms of labor in country versus who you have to bring from the outside?
Yeah, we don't have any non-South Africans. So we're 100% South African workforce. Some of them are South Africans who have left the country, but they're all South African. And South Africa is kind of like the home or the birthplace of this underground mining expertise. It's really disappeared. A lot of that expertise has disappeared in Canada and the US. And right now you find most underground mining expertise coming from Australia or South Africa. And I would say in the future, probably more tilted towards Australia because of the contraction of the mining industry in general in South Africa. So today, the expertise is all South African, still a competition for employees. So it's the markets hasn't really exploded the way it has in other countries in the mining sector in South Africa. So we're good. But we do need to add more people as we open up more faces and move more volume every month. And that like I said, that was my major thing keeping me up at night is HR and the availability of those people and the reality is we're going to have to be training people ourselves as well, just to improve skill sets. So it is a constraint.
Right. Are there any geotechnical risks given that Galaxy again has been in one shape or another being worked on for century, dare I say? So historic stopes, old pillars, voids, variable ground conditions, etc. How do you work around all that?
Yeah, it's in fact it's the rock techs and the geotechnical experts would tell you it's actually a very positive thing that's been there and it's been stable for such a long period of time. It tells you it's a very competent rock, and it's very stable and safe. So no major concerns. We've never really had rock fall type issues, collapses, that sort of thing. Knock on wood. But safety is always, particularly with underground mining, it's even more of a sensitive issue. So accidents that do happen, it is something we take very seriously, and it's as a single asset operator currently, it's a huge exposure for us. So even if it's a significant accident that's not fatal, it can result in us being shut down for a period of time, which would be difficult to handle. So huge focus on safety for us.
Yeah. This question here that I've got on my list is kind of in the middle of nowhere, but it is on my list and it matters. And it's about metallurgy and recoveries. What recoveries have you been getting this year? And is there room for improvement? Yeah. What does that look like?
So we're a different beast in that regard. So we have refractory ore. And it was one of the reasons why, Galaxy there was a company, East Transvaal Cooperative, that owned a series of mines in this region, and that they had a roaster, centralized facility, and ore would come into that roaster, and they could unlock and produce gold and out of this roaster, very environmentally suboptimal, let's say, but a very effective way of extracting gold from refractory ores that were not economically responsive to traditional extraction technologies and chemistries. Mm-hmm. And so the roaster got shut, and in the prevailing age of environmental enlightenment, that roaster is not getting reopened. There will be no roaster reopened in South Africa, and hopefully very few in the entire world, because they're huge polluters. So how do you get the gold out? Well, that was one of the reasons why this mine, Galaxy, was sort of sat and was available for guys like us to get, is it has highly refractory ore. So you could do a conventional CIL process. You might only recover 50 or 60% of the contained gold. And you have all this CapEx for the plant, and you have all this OpEx for running it. And then you're only getting 50 or 60% of the gold. You'd be doing fine at $4,000 gold, but $2,000 gold even? No. $1,200 gold, forget about it. You're shut down for sure. So it doesn't work. So the gold sits. So how did we unlock this? We unlocked it by taking a more simple approach. So we have a simple crush mill float process. We produce a concentrate, and we start with, we could say, about 3.5 grams per ton ore that we're taking to our plant. What comes out the back end is a concentrate that's about 10 times the concentration, so about 35 grams per ton. So still very low grade material, very high grade if you were mining it, but very low grade concentrate. That concentrate goes by truck about 200 kilometers to the port of Durban, and there it goes to an off-taker. What does that off-taker do with it? That's their business, but our understanding is they mix it with copper concentrate, Maybe it's coming from the Congo, maybe it's coming from Zambia. Again, not our business. And then it goes off overseas, probably to China. Again, we're not part of that equation. And it goes to a smelter, and there they get gold credits for whatever gold that was added by us, and we get paid. It's not an exact number; it varies depending on moisture levels and grades and all sorts of factors. But almost,
I'm sorry for interrupting here, Ravi. What are the payables? Like what's the percentage there that you typically get?
so again, it's 80%. So
Okay.
we're getting basically 80 cents on the dollar for the contained gold. So
Okay.
if we gave them 10,000 ounces that was locked up in that concentrate that we sent, we're going to get paid for 8,000 ounces.
Right.
And well, that sounds pretty bad too, Ravi, right? Like you're giving them these guys 2,000 ounces for it's a lot of money. It's $8 million. So what does it mean for us? So why are we doing that? So number one, it unlocked this whole thing because doing the CIL plant doesn't work economically at normal gold prices. Number two, we were able to get into production without the capex of a CIL plant or other processing steps, and I'll talk more about what other processing steps you could add. So way lower capex. Number two, you don't have the opex of running the CIL or equivalent. And your operating risk. So, we could produce a tiny amount one month and a huge amount the next month, and then back to tiny amount for a couple months. Doesn't matter. It's going to this off taker. They're blending it with the huge copper concentrate resource. Maybe it's 10 to 1 or 100 to 1 for all we know, way more copper than we're setting in concentrate than our concentrate. And it still works. They don't care. Of course, they would want more, not less. And so while we went through our startup phase and we had much more variability, it just took that element out because you can't be feeding a mill or any other processing step where you're going up and down on volume. So it totally de-risked it from an execution point of view for us. So lower CapEx, lower OpEx, de-risking from an operational point of view. So that's how we got unlocked the Galaxy deposit and this highly refractory ore, getting paid 80 cents on the dollar. You think about it. So we put that into a CIL, and it was, sulfides, conventional sulfides. Maybe you're getting 90 to 92%, something like that. So we're not losing that much, especially when you consider the savings on OpEx and CapEx. So what's the bigger picture plan? Well, 20 kilometers down the road from us is Barberton Mines. They're kind of exactly like Galaxy, but 25 years ahead of us. So very similar geology. It's kind of the asset that helped create what's now called Pan-African Mines or Pan-African Resources, London-listed company, couple $1 billion market cap. I believe they're producing 72,000 ounces a year. So, maybe we'll get to that level one day in the future. It's not in our current mine plan, but their geology is very similar. As I said, they're about 25 years ahead of us, and they just put out a couple months ago a new mine plan that takes them to 2051. So another 26 years into the future at that operation, very similar to us. They have sort of a century of ore ahead of them, and it won't stop in 2051. They'll be going much longer than that. What do they do with their refractory ore? Do they do the same thing? No, they have what's called a biox plant. So a biological oxidation step using bacteria. And it sounds pretty futuristic, but it's been around for 25 years and not easy to get working, but it does work. So they enjoy something like 90% recoveries, but they did have the CapEx and of course the OpEx of running this biox plant. And they get that sort of circa 90% recovery. They're also been running for decades, so they have a very consistent ore feed, which is an important thing to having one of these plants succeed. And fast forward 5 years, we'll have a very consistent ore feed. We'll have a higher volume. We'll be in a tremendous financial position. We will very much consider building our own biox plant. So and the fact that for a very similar ore type, it's been proven to work for years and years and years at a deposit 20 kilometers down the road. It tells us it's going to work for us too, but not a risk or a capex that we wanted to take on last year or even this year. It's something that's a few years down the road for us. And then it's just going to be so like that extra 10% is when you're producing 40,000 ounces a year, that's an extra 4,000 ounces. That's today's prices. That's $16 million, right? So that's, that pays for your plant in 1 year.
Yeah. That seems like a clear capex decision there that you can easily make. How do you make the rest of those decisions? How do you split the budgets between working on your own ground? You said you're not spending anything on exploration, but then you think about potentially M&A, and then eventually or potentially giving it back to shareholders through a dividend or an NCIB or something like that.
Yeah, I think it's a case in numbers, as Vaughn is saying. So it's any investment. There's your critical path capex. So like our underground development or the modifications to our plant required to get us up to that 40,000 tons a month. Like we're going to make those. Like that's there's no. It's maybe some phasing or timing or sequencing type issues, but those are critical path items. Doing something like solar, that's a timing issue, which is more like availability of funds. Comparing it to is it better to build solar and get an 18-month payback, or should I buy back 2% of my shares outstanding? So it'll be more of like these. I don't want to call it optional capex, but call it discretionary
Mhm.
capex, and so we can compare it to other choices of what to do with that capital. I think based on what's in front of us, the likelihood would be very much heavily tilted towards share buyback versus dividend for the foreseeable future. But hopefully at some point, especially if we bought back some shares and we show several years of generating more and more cash flow, then our shares will be priced differently. It won't be as obvious to just buy back the shares, and we can start putting money in the jeans of shareholders like me and hopefully you through a dividend.
I am actually wearing jeans right now, even though it is a podcast and you're not supposed to wear any pants. So that is
Yeah.
a good point.
Good to know.
It looks like time has advanced quickly here, so I'll keep it moving and switching gears maybe a little bit to the summit restart. What do you need to line up to have this restarted in again H1 of next year, and how much is it going to cost? You talk to me a little bit more about that.
Yeah, so there's two parts to it. One is the plant, and the other aspect is the mining side. And the plant is in fantastic shape. So this has been on care and maintenance since 2013, but it's been very well maintained. And so we have some minor capex related to the tailings facility and to the plant left. We're talking tens of thousands of dollars at this point. So that's the ongoing work and small numbers. So that's in really great shape. We're also staffing up around that. And then on the mining side, we're going contract mining. So we're doing some minor, again, tens of thousands of dollars, rehabilitation, cleanup kind of work around the mine site. And working with legal counsel and other consultants on making sure all the permits are in place, everything's in good standing, all the notices have been posted, and we're in the sort of last stages of selecting a mining contractor. So the capex is basically on the contractor, and then it's on us for mobilization payment and of course ongoing payments against tons delivered to our plant. So round numbers, it's going to be less than $3 million total cost before we start getting production back. And we forecast only 2,000 ounces of production for all of 2026, so stub year. We're not doing some big development to get in the ore body. The way this one went bust, there's a drill literally left in the face of the ore body. So they were mining, found out they weren't getting their next paycheck, and guys, turned off the machine and just walked out. So that's how ready to go it is from a mining perspective. It really is ready to go. Nonetheless, we want to make sure that we have a smooth startup and we can stockpile some ore, so we have a continuous feed for our mill. So we're forecasting a really modest number for 2026. But amazingly, even on 2,000 ounces at today's gold prices, it can break even. It's $8 million of revenue. And that covers our startup costs and our OPEX for the stub year in 2026. So and just looking at what does that look like? That's like kind of like 1 month's free cash flow from our Galaxy operation in 2026 at today's gold prices. So from a financial stress point of view, it's not stressful. It's a great position to be in to going into that restart.
Yeah. How's the community situation there? Is there any legacy challenges or anything that the previous operator didn't do correct and kind of pissed off the community? And how's that for you right now?
Oh, I'd say, look, that part of the state is very mining friendly. It's, the history there. Billy the Kid lived in that community once upon a time, worked in the mines. and it's a huge generator of employment in that part of the state. Freeport is got a couple big mines in New Mexico, and they employ a lot of people, and it's a high unemployment rate there. So I think the restart would be really welcome for sure in our region, and no serious pushback of any sort.
Mm.
It would be unambiguously positive for the community to have us going again, and I think everybody sees that.
Is that the case in South Africa as well? By the way, I didn't ask you too much about that.
It's varied. So in the last year plus, it's been, I'd say, again, unambiguously positive because we've been hiring more people. We really try to hire from the community where possible. We put more money back into the community through these production bonuses and hiring more people. So the money's flowing, the economy's flowing, and that's in the face of otherwise like a lot of economic challenges. So I think we've been very positive in the past year. In years previous, it's something that's been an issue. So we've done our best to manage it, and I think the best thing that we can do is. There's no environmental concerns or anything like that of any consequences. We're obviously subject to all sorts of reviews and monitoring. It's really, are we continuing to be a net positive and good actor in the community? So with the availability of more free cash flow, so we're only going to put more in terms of social investments, infrastructure investments that benefit everybody. And really the single most important one is just putting more money into the local economy by hiring more people and paying more and more out in both salaries and production bonuses.
With the second operation in the US, is your G&A going to go up?
No. So almost all of in fact, we did a little bit of benchmarking. So it's a bit of apples to oranges because you really should normalize this for size of production. But we had the lowest G&A of any producer that was listed that we could find using a cross-section of names, primarily on ASX and TSX. So we operate with a very lean top company. Nobody's got an office or an assistant or a company car or anything like that. There is a lot of flying, all the commercial, and fair salaries are paid. There's no skimping on salaries or anything like that, but we're just not wasteful. Adding the second production unit, we have a general manager that's going in place there, an admin team, about 22 people on the processing and admin side. That's all operational level. Mm-hmm. And our same CFO is going to be amortized now over two operations. I'm amortized over two operations. Our board, our listing costs, our legal costs, our insurance, all that stuff's now amortized over two operations. So on a per unit basis, our G&A is going to go down, and on an absolute basis, it's just going to go sideways. Mm-hmm. At some point, we'd have to have more financial staff supporting our CFO and so forth. These can't have like 6 operations reporting into him and doing all the accounting work and consolidation and audit and that sort of stuff. But for now, no change.
Marketing, I wanted to ask about that. You said there's been a lot of flying as it is in our industry. Not a lot of it has been for marketing because you've not been marketing a lot. Is that going to change?
It's going to change. It's started to change already for me. So I think it was virtually I did a couple conferences in the US post-COVID. But otherwise, it was almost a 5-year drought of not doing any sort of broad-based public appearances, and not zero, but close to zero in terms of either institutional or retail direct one-on-one marketing. So why was that? The main reason was it was just time and money wasted. There's no audience for it. Nobody cared. And for part of that period as well, we didn't have a good story to tell. So I would have been going around telling people, I'm not sure, I can't give guidance because I'm not totally confident in our ability to fund the growth. So there's just no sort of logic or motivation to do that. What changed is things started to come together for us in Q1 and Q2. And we now have a much higher confidence interval to the extent where we're comfortable giving production guidance, including several years out. Then the next layer was giving guidance on the restarted summit in terms of time frame and production volumes for next year. So as that confidence interval went up, we felt, okay, it's worthwhile. We're comfortable going out and we have a good story to tell and overlap or overlay on that what's happened in the gold price environment and the sector in general, and lots of interest, kind of like coming out, reaching out and grabbing us and saying, like, we want to talk to you, we want to hear what you're doing. So we are now, like, I think the first presentation I did was October, and I've done a couple since then, and there's going to be more of it. We still have no investment bank relationship or no analyst covering us. Why is that? So we've never paid anybody any commission because we did one financing, I think, in our 14-year history, which was we used the use of proceeds was to buy Summit. That was 4 years ago. Otherwise, we haven't paid anybody anything. So if you don't pay anybody anything, you don't get analyst coverage, and that's an issue for us. We want to get that going at some point, but we'll figure it out without having to pay somebody. That will be helpful for us to have something out there, third party in the public domain, that somebody who's really done some concerted research and can explain the value and what we're doing with our business. But as of now, I think that's on management and me in particular to go out there and keep telling the story.
What's the most fair criticism of Golconda that you've heard after you kind of fixed up the situation, or the one that you hear right now when you're out there talking to people?
There's a very clear answer to that one. It's kind of an extension of the Rick Rule theory, which is call it you've got two small underground mines. Who cares? Why should I ever care? You're not going to be in any major index. You're not going to get bought out by Newmont. Why? What would I care? So that, and again, all factually correct. Why should you care is if you are somebody who wants maximum exposure to gold price, and in a company that's not just going to have their boat floated because we're in the sector, but because we actually financially benefit from every dollar on that gold price 365 days a year, intertwined with a management team that is totally capable of making mistakes, but is very clearly aligned with shareholders and cares more about the share price over the long term anyways. We don't care as much over the short term, but cares more about the share price than like trying to make the company bigger so we can get bigger salaries or justify larger bonuses, and working for bigger salaries and bigger bonuses. We're working for a larger share price, and that's what we offer to shareholders. Is we're aligned, and we're giving you super leverage to gold price. If that's something that appeals, look us up.
I know you have to run now, so I'll let you go. I'm sure there's a lot more that we could be talking, but hopefully I'll be talking to you over the next couple of months as well. For people listening and watching, if I'm forgetting to ask something, which I most definitely am, let me know what it is and I'll ask it next time. What do you think, Ravi? What am I forgetting to ask you? What did you come here hoping to talk about that I failed to bring up?
Well, I always love talking about gold price and where that's going, but I think that's another hour or 2 hours or maybe 2 days to go through that. I think we hit all the key things, like why should I care about Golconda? What's what are your largest risk factors in terms of executing on this plan that you put before us? What really is your alignment, your smell test? I think we covered all the bases. The parting message for me to any potential investor is, if you don't have a view on gold, then it doesn't make sense to own shares of a company like ours. If you do want to manifest a view on gold, then the safest thing you could do is buy bullion. The second safest thing is invest in royalty companies. And then if you still have risk appetite and you want leverage beyond that, something like Golconda Gold is really a good opportunity, because those two reasons: we have actual financial leverage 365 days a year to the gold price. And number two, you're dealing with a management team that is aligned.
Thank you so much for your time.
Thank you.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias. Again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should, under no circumstances, be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. Oh, so unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find a company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."